In this lecture on outbound taxation of electronic commerce, we focus on the taxation of U.S. companies in non-treaty countries. The objectives of this lecture are as follows: to understand the potential for taxation in foreign countries, understand the relationship between U.S. tax rules and foreign tax rules. Let's start with the potential for taxation in a foreign country. As discussed in the text, because all foreign countries all have different laws, we cannot make any generalizations as to the potential for taxation in a particular country if that country is not a treaty country. What this means is a U.S. company doing business in foreign countries, either through physical presence in the country or virtual presence because of online sales, cannot assume a single set of guidelines that will be applicable to all countries. Each country is unique, and tax compliance in each country has to be approached separately based on knowledge of that country's tax laws. The taxation of a U.S. enterprise that receives revenue from a foreign country that does not have a tax treaty with the United States depends strictly on the tax laws of that country. This means that a U.S. company is entirely subject to the tax laws of a foreign country on sales to that country's residents. This assumes, of course, that the foreign country is in a position to enforce those laws. However, a foreign country can usually enforce its tax laws against a U.S. company that is physically present in the country, has cash or other assets in the country, or is receiving payments from that country. For example, a foreign country may determine that a country has jurisdiction to tax a U.S. seller merely because the seller makes a sale to a customer in that country. If the tax laws of the foreign country impose a tax on the seller must pay that tax if the country can enforce its laws against the seller. The fact that a country's laws may be completely out of sync with the U.S. tax laws makes no difference in its ability to tax the U.S. seller. As another example, if a foreign country determines that a U.S. seller is subject to tax based on gross receipts, not net income, then the seller is so taxable. A tax on gross income is not unusual. The United States imposes a tax of 30% on certain gross income of foreign taxpayers, and in the United States, this tax is collected at source through withholding. Of course, a foreign country must be able to enforce its tax laws to make them viable. Whether a foreign country can enforce tax laws against U.S. sellers with no presence in the country is always problematic. However, countries determined to collect tax can exert extraordinary power over even an online seller. Witness, for example, the ability of China to shut down access to specific websites. China or some other country which cannot get voluntary compliance, tax compliance from a foreign seller can obtain involuntary compliance by threatening to shut down access to the seller's website. Let's now look at the relationship of U.S. tax law to the tax laws of foreign countries. The basic message here is there is no real relationship between U.S. and foreign tax rules when there is no tax treaty. What this means is the U.S. tax laws, which control U.S. taxation of the worldwide income of U.S. taxpayers, has no direct relation to the rules of foreign governments. A taxpayer in the United States will make a serious mistake in assuming that the foreign government will impose tax using rules similar to those of the United States. Having said this, there are some conceptual similarities in the rules of developed countries, such as the countries making up the OECD, but the dissimilarities are so great that it would be a serious mistake to use U.S. tax rules as a basis for making any assumptions regarding foreign tax rules. The only way to determine the tax rules of a specific foreign country is to get access to information regarding the domestic tax rules of the foreign countries in which the taxpayer is doing business. The best option is to obtain the assistance of tax professionals in those countries. These professionals are usually chartered accountants or attorneys. There are a number of online directories of tax professionals in various countries. Another option is to obtain guidebooks that explain tax laws in other countries. PricewaterhouseCoopers used to publish a comprehensive summary of the tax laws for a large number of countries. Other large CPA firms publish different types of doing business in books which summarize tax laws as well as other laws in foreign countries.